Just wanted to welcome you here today to find out a bit more about yours and others' taxes. What today is topic is the Tax Reform 2018 Explained. The new tax law is far-reaching and subject to interpretation and revisions, and will impact nearly every phase, family, and business starting in 2018. That's a big deal. Figuring out your strategy is critical, getting the best results for your wallet. So today, the seminar will cover the 2018 basic changes so that you can get a head start on meeting with your tax professional. The speakers today, George Noceti, a senior partner with the Integra Group at Morgan Stanley Wealth Advisors. George can be seen on KTVU, ABC, Cron. Look at all these initials.
No, too many.
And radio, TV. I mean, he's just a star.
But I'm not giving up my day job.
Yeah, well, okay.
If you see me, you know why.
Forget the startup stuff, right?
Yeah.
But probably just as important as all that is, he is a St. Mary's Executive MBA graduate. And his partner is his son, Paul Noceti, of Loyola Marymount graduate, has a BS degree in engineering.
I'll hold it against me. Still West Coast Conference, right?
Still West Coast Conference,
Yeah.
good, and you're a long ways away.
Yeah, exactly.
Anyway, so would you please help me welcome George and Paul?
Doug, thank you very much. You did a great introduction, just like I wrote it, so really appreciate it. Really good being here. You know, I go back to St. Mary's a long, long time ago. When I graduated from Reardon High School in San Francisco in 1967, 10 of my buddies, my really close buddies, had the resources to go to St. Mary's. I wasn't as fortunate, you know, but I did get to go to all the parties back in the late 60s and 70s, and there were a lot of them. It was an all-boys school then. And the school was not very attractive. It was really set up for all boys who had just trashed the place. And then about 1975, my wife and I, who grew up in San Francisco, both moved to Lafayette, bought our first house here. And we would occasionally be going out to St. Mary's, and it got a little better. I think they admitted women about this time, so we started to improve it. But then when I went back to get my MBA, it was really pretty nice. All the facilities have been upgraded. This is in the mid-'80s, and today, I mean, it's a jewel. It's fantastic. And it's become kind of a mecca for people to come to and go to classes. And so I know some of you are from St. Mary's and some of you aren't, but you're here, and that's all that counts. So we're gonna talk about taxes, okay? And just a quick introduction. If you go back to 1986, Ronald Reagan, you know, he did the big tax changes. And it was interesting because at that time, he gave us individuals a huge tax break. I mean, the maximum tax bracket at that time was about 50%. Then it went down to the high 30s. A huge break to us. Got rid of some deductions also. We didn't like that. But anyway, got rid of some deductions. And for businesses, it wasn't as favorable for businesses as it was for us. So that's where kind of the deductions, came from. He was kind of a, pay-as-you-go kind of president, I think. I mean, that was the intent anyway. So fast forward to today. To December 17th, the new tax law was rushed and put together, and it was nonpartisan. It was put together, and this is what we have. So we're all kind of confused by it. We're all kind of learning, but every month and a couple of months it goes by, we're just learning a little bit more about it. So in this tax act, it's kind of interesting because it's actually, after we analyze it, we'll show you, fairly favorable to us. And it's also extremely favorable to business. So you got these two favorabilities, but you still have the expenses going, right? Government spending money, but less revenue will be coming in. And so what that's done different than the Reagan plan, theoretically, this is pushing out debt. And first it was $1 billion, or $1 trillion. Sorry, they all get mixed up, billions, trillions. It's all funny money. Anyway, $1 trillion. And a while ago, we kind of evaluated it about $1.5 trillion. And now we're really looking over the next 10 years, maybe about $2 trillion. So the theory is, you pump up the economy, you give us more money, we go spend more money, you give these breaks to corporations, and they put it right into hiring people and developing businesses. If that's true, then it kind of pays for itself. But we don't know. So unlike 1986, this is a little different model. But really, at the end of the day, all we care about today is how's it going to benefit us. So let's just talk about us. Okay? So we have a folder that Paul and I put together for you, our educational folders. So the first thing you'll see in there simply is, I'll just use yours for this, just all the slides we're going to use today. And if you wanted to take some notes, you're welcome to do that. Generally, what we like to do in a seminar like this is Paul and I just like to power through it. And you just take your notes, and your hand's going to want to go like this. And if we did that, it'd be very interactive, but we wouldn't get very far. We get to maybe the first page. Okay? So if you can just indulge me and hold your questions off until the end. Really hard to do. I'm going to challenge you not to do this. Then we'll answer your questions at the end. Okay? And so you have all the slides here, and if you want to take some notes with any questions you want to come back to for clarification, we can certainly do that for you. The other thing I think is really helpful in here, you have two documents regarding key tax changes, regarding the new tax law, 4 significant areas you ought to pay attention to. And then the other one is actually really good. It talks about the new law and the old law and the differences and things that you should consider, right? What you should do is going to be different from the person next to you. So these are principles, you see how they apply to you, okay? So we got those two documents that are really helpful. And then we have a really good article on IRAs, because this really kind of fits in anyway to taxes. And so many people make mistakes with their IRAs. And we're going to kind of relate it back to this presentation. But this is a really good article. They're all factual. They're all actionable. Things you should really read. Okay. So the other challenge I want to make for you, besides holding up on your questions, is just set a goal for yourself or an objective of getting all this stuff read by Tuesday. Yeah, if you don't read it by Tuesday, you know where it's going?
Yeah.
It's going in the other file and then the round file. So again, we're going to be talking a lot of information. Maybe take a few notes. We all retain whatever we retain. But if you go back and read these things, this will really help you, because it's all about how does this affect us personally. And if you're proactive, you get the maximum benefit. Okay? Because you got to be prepared when you go to your tax account. If you just wait for that, that's fine. But it's better if you're proactive, have the information, and you can ask the questions to the professional to make sure you're getting the correct tax treatment, especially with the new rules. Okay? So this article can be really helpful. And then the other item is simply our brochure about us. We're right here at Walnut Creek at Morgan Stanley. But of personal interest here is on the third page. This could be helpful to you. It's called Your Total Financial Picture. We just do seminars even on this. If you take all the noise about retiring and Medicare and Social Security, estate planning, your children, I mean, it's bigger than just a stock and bond. But if you take all the noise, you can put it into 6 buckets. And then within those 6 buckets, if you turn the page, there are questions for each of those buckets. It's just a self-help exercise that you can just do for yourself. You can prioritize the 6 buckets, look at each of those buckets, and check off the things that you haven't done yet. And instead of worrying about the world, you just worry about 1 or 2 things a month that you're going to take care of to make your situation better. Regardless of your wealth, everybody has to do something like this. So again, you got to take control, you got to take action, you can pay people and all that, but there's a lot of things you can do. So this people find to be very, very helpful. So I'll just leave that with you. And then there's an evaluation form here. At the end, something that Paul and I do with our clients is that with the new tax law, we develop this checklist of 50 questions that we ask our clients, and then we discuss it, and then we give them a list of corrective actions that they can then go take to their CPA. So if you're interested in that, you can sign up and we'll help you with that. So with that, I will get started. And those materials are really more for later on, except for the seminar notes that you can use. So we're going to cover 3 topics today.
Thank you.
Paul is going to cover the key provisions of the new law. And I'm going to talk then about some of the applications, planning considerations, and strategies. Again, this is just education. This isn't advice, because how you apply this is going to be different for everybody. But it gives you things to think about that when you go see your tax person, you can ask the question. because they, like anybody, this thing was dropped on us. There wasn't a committee meetings and a bunch of seminars. It was just done, 2017. So what's the effect? Some of the things we know, some of the things we don't know. So again, if you write down some notes of questions, you're paying somebody to help you, you can get some answers and get the most tax efficiency. Not wait till the following year to figure it out. So, and then the third thing I'm going to talk about is related back to the Tax Act is charitable giving, because there are some things now that you can do that are a little bit more helpful. So with that, Paul?
Perfect. So I'm going to talk about some new key provisions with the tax code. It's either going to be good news or bad news, or maybe a little mix of both. But ultimately, you know, the new tax code generally is a good thing. We'll see some benefit, and then maybe not as big as we all might have hoped. But at the end of the day, it should add a few extra dollars in our pockets. So just some of the highlights of the new tax law, and then we'll go into more detail on each one of these. First of all, everybody gets lower marginal tax rates. The 7 tax brackets have all been reduced in their marginal rate. This also applies to estates and businesses as well. Generally speaking, we should see lower tax percentages on our income. There's also been significant changes to the deductions that we can take, as well as the elimination of personal exemptions. That has been taken away from us. We'll talk about how this all balances out. We'll talk about a hypothetical family, what they paid in taxes in 2017, and what they'll pay in taxes for this year in 2018 under the new law. Good news is, for retirement savings, there's no changes here. So contributions to 401ks, the handling of Roth accounts, whether it be a Roth 401k or a Roth IRA, that is still tax-free withdrawals. Big benefit there. As well as educational incentives, so 529 plans, funding for child education. That still stays intact. We still get the benefit of using the proceeds from a 529 plan for post-secondary education on a tax-free basis. But they added the ability to pay for education prior to post-secondary. So that would be like private schools before college. However, there's a limit of $10,000 per recipient. So you can't make multiple plans and have the same recipient. It's all based on one recipient, $10,000. The individual mandate to purchase insurance has been repealed. We all kind of know why this occurred. They're trying to basically slow down the Affordable Care Act. But basically, this will disincentivize people to participate in that plan. We haven't really seen the big effect of this yet. So far, people are still signing up and participating in it to get health care coverage. But there's no longer that mandate where you get penalized if you are not enrolled in an insurance program for health care. The cost of all this, by reducing the taxes across the board for businesses and for individuals, is going to end up costing us in the deficit. It's estimated to cost us between $1.5 and $2 trillion over the next 10 years. But as George mentioned, you know, the idea behind this is to spur the economy, to spur spending, and that will offset this reduction in revenue from taxes. So we're trying to pump up this economy and keep it going for a longer period of time. Good news, donations have increased their deductibility. So it went from 50% to 60%, so more incentive to help charitable organizations such as St. Mary's College, right? So there's a bigger benefit to that to help reduce our expenses. So the tax brackets for individuals. There's still 7 brackets, but basically for single individuals and for married individuals, what they've done is they've reduced the percentages that you pay. So for married individuals, that 15% tax bracket has gone down to 12, 25 has gone to 22, 28% tax bracket has gone to 24, 33 to 32, 35 stays the same, and then the highest tax bracket, that 39.6, has been reduced down to 37%. They've also changed the limits here. So I know this is written kind of small in the slide notes, but this is pretty easily pulled up on the internet. I think we also have it in one of the sheets there as well. But basically, I'll show you the result of how this all works out for people. But generally speaking, most individuals are going to take home an additional $1,600 of additional pay that otherwise they would have been paying taxes on under the old law. So not a huge effect by reducing those percentages for all of us. It also shifted a lot of people into the higher brackets because they reduced some of the limits. So it's not as big of a change as we all might have hoped, but all in all, it should add a few more dollars into your pocket. Capital gains on dividends tax rates on dividends and capital gains has actually not been changed at all. The way this is set up is these were tied to your tax brackets. So basically the 10% tax bracket and the 15% tax bracket, if you were in those brackets, these were the old numbers right here, and you paid 0 taxes on capital gains and on dividend income. If you were in the next 4 tax brackets, you would have paid 15%, and then the individuals that were in the 39.6% tax bracket, the highest tax bracket, they had to pay 20% taxes on capital gains and on dividends. Today though, since we've shifted and changed those tax brackets, basically they just left these numbers unchanged. So they didn't shift it with the new tax brackets. It's now an income level. So it's no longer tied to that tax bracket. It's just purely based off of your adjusted gross income, and that's going to define basically what you're going to pay in taxes on capital gains and on dividends. It is mentioned though that there is a 3.8% surtax on investment income. That's for individuals that are single, earning more than $200,000 in modified adjusted gross income, and for couples, $250,000 in modified adjusted gross income. So if you're in the highest tax bracket, you would jump up to actually 23.8 in taxes there. On the deduction side, pretty significant changes here. Though they've lowered our marginal rates, they've taken away a lot of the common deductions that we typically used in filing our taxes. So the standard deduction has been doubled. Now it is $12,000 standard deduction for an individual and $24,000 for married filing jointly. This change right here is going to have a big impact on everybody. Typically about 1/3 of the population did an itemized deduction. Now that's going to be less than 10%. Most people are going to simplify their tax return and end up taking this standard deduction. So simpler process, simpler setup there. Mortgage interest, big effect for California, right? We have high property values out here. This has a big effect for all of us. It used to be $1 million you could deduct interest on. They've reduced that down to $750,000. That will include your primary mortgage, and then if you have a HELOC or a second, that gets added up on top of it. So if you have a primary mortgage of $800,000 and you have a HELOC of $100,000 on top of that, you can't get that all stacked together. It's limited to the debt or the interest on $750,000. It's based off of when you closed your loan. So if you closed your loan prior to December 15th of last year, you're grandfathered into that $1 million provision where you can deduct the interest, but anybody closed after December 15th of last year, it's limited to that $750,000. The $100,000 add-on for the HELOC has been taken away, so you have to add those two together, the first and the second, to figure out what you can deduct in interest. State and local taxes, otherwise called SALT. This has been reduced down to $10,000. So this is another big effect for California and Bay Area residents. If you pay, let's say, $12,000 in property taxes and $15,000 in state taxes, you can only deduct up to $10,000 for your tax return. So there's a significant limit there for individuals. Medical expenses. It used to be that you could deduct anything over 10% of your adjusted gross income in medical expenses. For last year and this year, for just a one-time period, they reduced this down to 7.5% of your adjusted gross income. So more of your medical expenses can now be deducted. However, that's going to go away after this year. It's going to jump back to 10%. So it's a momentary time of relief, and then it'll pop back up. Miscellaneous expenses have all been repealed. What this was if you had an unreimbursed employee expense, investment expenses with your advisor, you can deduct those. Tax return expenses, you can deduct those. No longer, right? That's all gone, unfortunately, so we can't reduce that off of our tax return. And then, as I mentioned, charitable contributions, it has been bumped up to 60% from 50%, so that's a nice thing to add in there. Now, we talked about reductions. This is a great thing. Now we can actually talk about a credit. So this is lowering your actual tax bill, not your taxable income, but how much taxes you pay. So they now have the child tax credit, or CTC. This has gone from $1,000 to $2,000. So they basically doubled the amount you can reduce off your tax return for any qualifying child under the age of 17 at the end of the year. If you have anybody over 17 that you're filing as a dependent, you can deduct $500 for those individuals. This is going to be phased out. A lot of these provisions for individuals are going to sunset in 2025. Now, that doesn't mean that it will go away. It just means that if nothing changes, it will go away. But with the Bush tax cuts, they were extended under Obama. A similar thing could happen. We'll wait and kind of see how this works out. But this tax credit is phased out as income exceeds $200,000 for individuals and $400,000 for married filing jointly. Those numbers used to be a lot lower, so not a lot of people were able to take advantage of the tax credit for children. Since it's been bumped up, a lot more people will actually take advantage of this tax credit. So previously it was $75,000 for individuals and $110,000 for married filing jointly. So they significantly increased this. A lot more people take advantage of it. Alternative minimum tax. This is going to go away for many, many people. So a lot of people that were affected by the alternative minimum tax, most likely that is going to go away for you. So the way it works now is they've increased the threshold to $70,300 for individuals and $109,400 for married filing jointly. But since they've taken away a lot of the deductions you could take originally, and they've increased the threshold on the alternative minimum tax, what happens is it's expected that only about 200,000 tax filers are going to be affected by the alternative minimum tax. Before, it was about 5 million people. It was significantly greater. That's going to change. It's going to simplify our tax return a lot more. A lot of people that get incentive stock options or large capital gains in their returns, that usually kick them into these alternative minimum tax. That's going to be severely reduced, which will be a nice thing for individuals. So let me give you an example of how this would change for a standard family here. So we'll take a family of 4. They have 2 children, both under age 17. They're in the 28% marginal tax bracket previously. Now they would be in the 24% marginal bracket. They're going to claim a standard deduction. So originally, they would have $200,000 of adjusted gross income. They get a $13,000 standardized deduction. They would be able to take a personal exemption for the children of $16,600. So they would have taxable income of $170,000. They would then pay their marginal rates, about $34,335 of total taxes, and there would be no child tax credit for them because they earned too much under last year's provisions. Under the Tax Cuts Job Act, our new tax code, same income, they would get almost twice the deduction, so they get a $24,000 standardized deduction for married filing jointly. They would lose their personal exemptions. So due to that, they would actually have a higher taxable income, $176,000 compared to the $170,000. But since they're utilizing a lower tax marginal tax rate, they're only going to owe $30,819. Then they can reduce that down by the 2 children, $2,000 for each of them, $4,000 reduction, down to $26,000. So a savings of $7,500 for these people filing their taxes. So pretty good when you end up looking at it down the line. However, it just really depends on everybody's situation. Estate taxes, pretty significant change here. The tax rate margins go from 18 to 40%. on estates and gifts. The big change, though, is the threshold. So it used to be that the threshold was a little over $5 million per individual. So for two married couple, it was about $11,200,000 for the family. They've now doubled that. It's now $11,200,000 per individual. So now we're up to $22,400,000 before you have to start paying estate taxes. This is going to significantly reduce the amount of taxes and passing that estate to beneficiaries. They also increased the gift tax exclusion from $14,000 up to $15,000, so you can now gift a little bit more out of the estate. This will sunset in 2025, so under the current rules it's a momentary time. However, these things can be extended and they can continue on for longer. We're kind of in a wait and see. But right now this will continue until 2025, and then it'll drop down to the original rates. They do increase this number based off of inflation each year. They've adjusted the way that they look at inflation. It used to be core inflation. They've now adjusted it down to chain CPI. It's going to basically reduce the inflation on a lot of these provisions. Taxes, big changes here. These are permanent changes. Originally, corporations in the United States paid a 35% corporate tax rate, making us one of the highest in the world. They've now brought that down to 21%, which is much more in line with developed nations. Most companies, though, in the United States are not large corporations. They are S-corps, limited liability companies, or sole proprietors, where the income is passed through to the individual at the individual tax return, so they're looking at those individual rates. However, the big benefit for them is that there is a 20% deduction on qualified business income, subject to some limitations. So you can deduct some of that before it hits your own personal tax return. And once again, instead of 39.6, that highest rate has been dropped down to 36. Capital spending, the government is trying to incentivize corporations to reinvest in growth and expansion. So they're allowing a 100% deduction on spending on new goods and machines and so forth. Then the big one is the repatriation of overseas profits. There is a fixed tax rate of 15.5% on cash and then 8% on non-liquid assets. Any overseas profits of U.S. corporations, whether they bring it back or not, is going to be considered repatriated. So as long as it's a U.S. corporation with overseas profits, over the last 30 years they've been doing this, that is going to be all considered repatriated. There are ways around this. They make other, basically, corporations outside the U.S., but this should bring a pretty substantial amount of cash back in the United States, create some tax revenue, and then keep that cash here for growth and expansion. So with that, George is going to take these updates and then talk to you about some planning considerations.
Okay, thank you very much, Paul. So again, there's a lot of pieces to this law. We only have 45 minutes, so we're doing the best we can on that. But this will kind of give you some data to read and some content to be thinking about and some notes to act on when you talk to your CPA. So let's talk about some planning considerations and some strategies. So there's 5 things we came up with to kind of look at now on income tax planning strategies. The first one is to consider investing in muni bonds to generate tax-free income. So with higher tax brackets, California Muni Bonds, which as you know is a not-for-profit organization, you're really lending them money, and the organization is paying you a coupon, you know, every twice a year, and at the end of the term you get your money back. Okay, if the muni is still, it could be school district, it could be UC Berkeley, you know, etc. So it's quite common for people to buy California Muni Bonds because as we get older, we want to have tax-free income. So it makes sense to do that. When we had the higher tax bracket, it was more beneficial. It's still beneficial today to generate tax-free income. So whether the income rates have gone down a lot or not, and it's also important for those people that have, you know, couples filing jointly $250,000 in kind of net income at the end of the year. Anything after that, they're subject to the 3.8% Medicare surcharge. So you can just kind of see you got your right bonds, the right coupon, et cetera, et cetera. Now, there's other strategies you can use to avoid or reduce taxable income. You kind of want to get in the lowest bracket you can get in. So you can perform that out with your tax professional, and then maybe you can tweak a couple of things to get under that window, because the windows have changed now. So a couple of things you can do is if you're still working, you have a retirement plan, right? So for 2018, you can tax defer into your 401k, your 403b. You can tax defer $18,500, and if you're 50 or above, you can do another $6,000. So that's $24,500. So when you get your first job, you start putting away right away, and you've got a long runway. My runway's short, but your runway is really long, so that dollar will compound and compound over a period of time. Plus, you have more longevity than I do, so you got to put away a lot of money. So all of us, if we had that opportunity, fine. But those that are still there, and we haven't quite, put as much in, we want to try to double down while we can. It helps to avoid tax, and or defer tax, and it helps to ensure that after the paycheck stops, we have a sum of money that we can work with. You may have a flexible spending account at work. It's a lot of nonsense. It's a lot of work to do this. But if you have a flexible spending account and you can pro forma out your medical expenses that you have to pay for, like your deductibles and co-insurance, if a child that needs orthodontia, you can throw that in there. A lot of the medical expense, eye care that you're having to pay for, if you can project that out, maybe discount it a little bit, have money, you're going to pay for that money, tax deferred, tax free by maxing. But a lot of people they get a little lazy and they don't really take time to do this because you have to kind of watch your spending. You got to submit receipts and all that kind of thing. But all these little things add up to more spendable income or more money you can put away. It's the little things you have to really watch. And the other thing is health savings accounts. Now, we really like these because, and younger people don't really participate in it when they have it available because it's so far out there. But basically, a health savings account, you get deducted pre-tax out of your payroll check, goes into a health savings account, it grows tax deferred, and when you use it for medical expenses, it's tax free. So why is this important? Well, you retire, you're on Medicare. Well, what does Medicare cost per person? Paul and I project that it's about $6,500 a year of expenses you have to pay. Well, that could be offset with a health savings account. Now, if you don't have it, then don't worry about it. But if you do have it, you want to, again, take a step back, do your own financial planning, and consider doing that. We like it when our clients come and they have money in their health savings account. They don't have to take money out of their portfolio to pay for health care. And for the baby boomers on up, this is one of the two things we have to worry about. Running out of money, because we're going to live a long time, and the cost of health care. This thing's going up 6% a year minimum. And when we exceed certain limits in the government, our costs are being increased. We do a whole seminar on Medicare, so we know the cost. And looking out into the long term, if you think healthcare isn't all that bad right now, it gets bad over a period of time. So you have to have money put away to pay for healthcare expenses. And then if you have the opportunity for deferred compensation through your corporation, again, a lot of people don't take advantage of it. They want to have money now and pay taxes on it. But if you can defer the comp for later on when your income's down, that would be a very, very helpful thing to do. Or if you have a situation at work where you can buy company stock at a discount. Even though, again, that takes away from your free cash flow, but it's all about having enough saved for the future, since many of us don't have pension plans, right? You retire, your paycheck stops. It's what you've put together plus Social Security, which you really have to maximize taking it to get the maximum benefit. And Paul and I are kind of considered to be experts in that area, so deferring is really important for Social Security. And then 529 plans. Now, as Paul mentioned, this is kind of a good thing, so we've been encouraging parents. I mean, if you have a baby on day one, we will tell you you're going to get a bill in 17 years for St. Mary's College. It's not going to be pretty. It's expensive. So you want to start putting away, because you know you're going to get a bill, so you want to start putting away. And they say, well, George, we don't really have the money to do that because we're just starting our family. No, you go, great. The grandparents will help. Just call them up and tell them, don't send us toys or clothes. Contribute to the college savings plan. That's the gift that keeps giving. Clothes and toys go away. So we like to see people build up their 529 plans. Problem is, they've only been good just for post-secondary education. But with the new tax law now, there's two wrinkles in it. One, it can be used for elementary private school and elementary, junior high, and high school. It can be used for that. It can also be used for, if you follow my rules, and as soon as you have your baby, I say get a 529 plan, and you do what I ask you to do, and we get it started. But, you know, as life happens, I mean, things happen in life, right? The child develops special needs along the way. And maybe isn't going to St. Mary's College, okay? But that money in a 529 plan, part of it can now be used for living skills and vocational kind of training for people with learning disabilities. So, you know, there's always the pros and cons of all these investments, but that's another positive thing that's happened with that. And then you have to be mindful of transactions that might drastically put you in a different bracket. For example, things are going great, you got your cash flow, you got your brackets, and in this year, 2018, you turned 70 and a half. And those of you in the room that are in that age group, I call you up, we got to take the required minimum distribution. So it's 3.65% of a little bit of assets or a whole bunch of assets. And you go, you know, George, I don't need that money. I have a pension, I have some rental income, you know, I don't, you got to take it. Well, I don't want to take it. Well, if you don't take the required minimum distribution, it's a 50% penalty and ordinary income. So you got to take it, right? But when you do take it, what happens? Bumps up your income. It puts you in another bracket. So you have to think about, because when you turn 70 and a half, you can defer the first year, but then you got to take 2 the next year. So you kind of have to do some tax and income planning to figure out when you should do these things. You have a house, you're going to sell that house, you're going to have some long-term capital gains. Do you want to do it this year, or do you want to do it next year? So this is all kind of the planning, because it's going to push you into a particular tax bracket. But I will say this, I don't anticipate taxes ever getting any lower, at least in my lifetime. I think right now they're the lowest we're ever going to see it. Especially if there's a political change in government. Okay, it's going to pop right up again. So we need to take advantage of these things, and I'll talk about some other things that you might consider for planning strategies. The other thing you can do is retirees can also donate your IRA assets, not to not-for-profits such as St. Mary's College. You know? So here's the thing: you're 70 and a half, you don't need the income. You think, George, what can I do? Well, a couple things you can do. One is you can take the income as required by law, pay your ordinary income taxes on it, and you don't need it for vacation or anything else. You can just, you know, put it back in your taxable account, into California muni bonds or whatever, and just continue growing it. Or you can gift it to a charity. That can be your RMD. You don't have to take it out and pay taxes. The RMD can go right to a charity. At 70 and a half, you can do that. And so when we do a little planning with our clients that are philanthropic, it's an efficient way of doing it versus giving a donation with after-tax dollars and getting some kind of a deduction. So there's a whole bunch of issues around this, but this is just one of the things to think about. Now, you also may want to consider Roth IRAs as a source of tax-free income retirement. So the way this really works is, if you're familiar with Roths, you have an IRA. You can liquidate part of the IRA, pay ordinary income on it today, and then you can put it into a Roth IRA. So a lot of people just do this, but they don't really think through the issues of when it's appropriate, when it's not appropriate. So generally, if somebody is in their 40s, maybe early 50s, and they want to take money out of their IRA, they pay taxes on it, and then way out, maybe beyond 70 or 75, they want to start taking a distribution. They've had enough time since they paid taxes on it, because if I put $1,000 in, and my taxes are $300, I have $700. I take money on the sidelines to pay the taxes, that's gone. I have $700 in my IRA. It's going to take that $700 to build back up to $1,000, and then I want to have a gain on it. So you will do this, but it takes time. You can't do it in year one and expect to take the tax-free income 5 years later and have some kind of miraculous gains and profits. So if you're younger, the conversion thing we do a lot with our clients. If you're older and you can still afford to do that, then you're not doing it because you're going to get this tax-free income, because you'll never hit the break-even point being older. But you may do it for estate planning issues. If you have beneficiaries, like if I do it now, today, I'm not going to see any benefit at all. But if I pass, when I pass, my kids can each be beneficiaries of my Roth IRA. And when I die, they get an inheritable Roth IRA, which they're required to take a tax-free distribution at their required distribution rate. So if they're really young, like I had to take out my first year 3.65%, okay? But them, because they're young, they may only have to take out 1%. And what's the Roth doing? It's growing at 4, 5, or 6%. So I have to take out 1 tax-free, and it's growing. So my assets inside the Roth, I'm really stretching it from the original benefit they got to a bigger number, and it becomes an estate planning for the next generation. So these Roths, you just have to, on all these things, you have to drill down on the details, on your situation. What's the cost? What's the benefit? What's the risk? But it's just a quick idea that we do a lot, especially with our clients that want to get money out of their estate and push it out to their kids a lot earlier. It's a tax-free way of doing it. Then you want to maximize deductions years when itemizing. So as Paul mentioned, the standard deductions, or the itemizing deductions, is really kind of going away now for most people because standard deduction is really high now. Okay, but people that are really wealthy, they can exceed that and come up with a whole bunch of deductions. You might be really wealthy income-wise one year, and not so wealthy income-wise the next year. So that's where the planning comes in. Should I file my standard deduction or should I itemize? Most people are going to file standard deductions, but if we have big swings in income, we're going to kind of take a look at this. We might even want to lump sum our charitable giving, not every year. It's planning. It's what's the year that we have, we need another itemized deduction to hit this threshold. Okay. So just something to think about. And then also, you got to take tax-smart withdrawals in retirement. So you just have to think about this. You don't do the same thing every year. You do planning, financial planning, and tax planning. So you might want to draw from tax-deferred accounts, your IRAs, when you're in a lower tax bracket that year, right? Because when it comes out, it's taxed at ordinary tax rate. And from taxable accounts and tax-free accounts when your tax brackets are higher. Also, because deductions are kind of limited, a lot of people are doing something, they're investing in donor-advised funds. Okay, so let me just, this has been kind of popular now and really hockey stick growing, and foundations do it. So at Morgan Stanley, we have a donor-advised fund. Schwab has a donor-advised fund. Fidelity has a donor-advised fund. The San Francisco Foundation is a donor-advised fund. So basically, at the end of the year in December, you're meeting with your tax person. They say, you know what? We should have got together earlier because you need to make a $100,000 deduction to get your income down, or 50, or whatever it is. Okay, and it's kind of too late. You don't have a lot of thinking time to do it. I get calls all the time. George, I got 100,000. I want to put it into the donor advised fund. So on December 30th, they give us a check for $100,000. We put it into the donor advised fund. That's a donation of $100,000. They get an immediate tax deduction. Now, they haven't had a lot of time to figure out who they want to gift it to, so they can hold it in the donor advised fund as long as they want. It's invested, and they can dole out of that $100,000, $50,000 for St. Mary's next year. $20,000 for their high school, another $30,000 for their spouse's college. Look up, I made a note here, donor advised fund, but it's a very, very powerful tool for philanthropic and charitable giving, and it can be done, on the fly, especially with the new tax law when we have fewer things that we can really deduct on. So we can give you more information on that in the future, possibly. But anyway, estate planning considerations. So this is Paul kind of hit on this, and so with our clients, they would come in and they have a bypass trust where it's just 2 of them, so they get double the exemptions. Last year was about $11 million. Okay, and so we get a will and trust set up for them, and that's all nice. And that means that it's all going to pass. $11 million is going to pass tax-free, present value. But if they didn't have $11 million, let's say they had $16 million. So $11 million is going to go to their beneficiaries tax-free. But now they're going to give, that's what Gates and these guys are doing, they're giving their money away, because now we have another $6 million that most of it's going to be taxed. So typically what financial planner would do, you set up an irrevocable trust, an insurance trust. You spend money buying a life insurance thing, and when that $5 million comes up for tax, the insurance pays for it. That's not uncommon. That's just, people just do this to reduce the taxes, pay some money now, but they want our beneficiaries to get more money. So that's great. So it's all set up. But here we are. It's 2018. Something changed. Okay, as Paul mentioned, for two people, it's 11 each. It's 22. So that person we set up with that ILET or insurance trust to avoid taxes on the $6 million, all of a sudden now they have insurance that they don't need, right? Because it's 22 million. So I'm just telling you, these things we've got to think about. So then you go to somebody and they have you plan for that. Well, the 22 million, how long is it good for? Till 2025. Everything that we've talked about for individuals sunsets in 2025. So you go to one estate planning attorney, they'll say, well, let's plan for the 22 million. Another one may not. It's a little complicated, it's a little confusing. But these are issues that we just need to think about, and if we can't decide, that's fine, but it gives us an opportunity to decide what we should do. And everybody's situation is really, different. So the other one is the qualified business income deduction. So this one is the one that hasn't quite been figured out, the application. Like what's deductible for businesses, what is not deductible. Well, George, is this deductible? I don't know. Go try it, and if they audit you, you're going to find out. We don't know yet, because we don't have all the practical experience. But basically, what it says is you have taxable income, because most people with these, individual consultants and sole proprietorships and LLCs, it all kind of rolls up to your tax return, right? So this is where most people are trying to figure out what they should really do, what formation they should really have. But the way this works is if you have taxable income of $150,000 for individuals, or $315,000 for married filing jointly, there's a 20% deduction available for including business services. That's just across the board: capital, business services, professional services firms. You can all do that. But if you're in a bracket over $150,500, but under $207,500, or $315,000 but under $415,000 married filing jointly, you fall into this bracket. So the 20% deduction is available to non-service businesses subject to wage limitations, which is a little footnote there. And that deduction is going to be phased out. So it's very complicated. If you have a business, you need to take this as an issue and then drill down with your CPA to find out the correct application for you. So if you're at $207,000 for individuals or $415,000 on your business, married filing jointly, there's no deduction for service type businesses. Okay, but other businesses can qualify for deduction up to 20%. So again, just an awareness thing. It takes a lot of drilling down and detail to find out the application to you. If you're a sole proprietor, if you're an LLC, if you're a corporation. Okay, so this is something to keep an eye on because it's not quite clear, but we're in 2018, and can I expense these things or not? Let's just talk about charitable giving. Okay. Here's the new law. Paul mentioned this. Cash contributions to public charities are now deductible up to 60% of your adjusted gross income. It used to be 50. So Doug, I mean, this is big for Doug, right? Because I just found you another 10%. You can get a bigger deduction, So it's a very, very positive thing. But a lot of high net worth individuals that are doing philanthropic giving probably not aware of it. So I know, Doug, you're going to be all over that with articles and things. So I'll give you a little promotion here. So nonprofits such as St. Mary's will be seeking bigger donors, of course, because you can give them bigger deduction, who can now donate at a higher percentage of their AGI to charities. And then high net worth individuals will be making higher contributions if aware of this beneficial change. So if we're looking for deductions, it's hard to do that. But there are some options to do it, and to not discuss it and not explore it, it could be a missed opportunity. Or they'll talk to you about it in 2019 after everybody's figured it out. So other charitable giving strategies, to help reduce your taxes, you can contribute highly appreciated securities to St. Mary's College and their charities. So we have a ton of clients that are older, and they bought IBM like for a penny. I'm serious, no, well, not a penny. And now it's worth whatever it's worth. So we're stuck with them. If they want to sell IBM, they have to pay 15% long-term capital gains on their gain. They made their profit, but on their gain. So they could then take that asset, not necessarily IBM, but something else. They could take that asset, they could donate it to St. Mary's College, and they get the full write-off on it. Not just what they paid for it. and they don't pay the taxes on it. So it's just another tax avoidance strategy. For people that have a lot of different securities, they can kind of, play different kinds of games with that. So just think highly appreciated assets can go to St. Mary's or others. Now there's donor advised funds. This is interesting too. You buy a piece of artwork. It's a legitimate piece of artwork that you buy, and you paid $10,000 for it. And at auction, you're seeing it go. The painter, you're seeing it go for $50,000. So that asset has appreciated. But how do you liquidate it? Okay? You give it to Doug, he's going to have a hard time. Oh, thank you. Where going to put it? So donor advised funds, at least at Morgan Stanley, can accept art. If you're a farmer in the Midwest, we can accept wheat, commodity. These are complex assets. The normal assets we see for contribution normally are stock, but also complex assets, LLCs, land. You may have land up in Calistoga that's kind of, you're just paying for it. You're not going to grow grapes on it. You said you're not going to do that. So you can actually donate that to a donor advised fund, and then that gift can be made to your charity that you want to. Some of the institutions can handle the complex assets, such as that. So there's no restrictions. You just have to find the right little niche. So again, we're a big fan of the donor advised funds for philanthropic charitable giving. And then you can consider a qualified charitable distribution, QCD. So this is really for those folks that are 70 and a half, have to make their required minimum distribution. You can gift that, without paying any taxes, satisfy your required minimum distribution, not pay the tax, make your charitable gift, but it has to be to a qualified charitable, organization to do that. So again, you want to seek tax and legal advice. You don't want to take any advice from this seminar. You just want to get the idea and then really, really drill down on it to see what's right for you. It takes time, but it's your money. You have to protect it, make sure that it sustains you, for the rest of your life. So as we close here really quick, I'll just make mention that we've spent a lot of time putting together a 50-point checklist, which is kind of a matrix, of all the areas of tax on all the schedules of your tax return. And it asks, we did this for our clients actually. We ask our clients a series of 50 questions, and if it's applicable to them, we write a note and an action step, and then they take that document and they bring it to their CPA for the pre-planning meeting. So people have found this to be tremendously helpful. So if anybody's interested, you can come in and as just a guest of this seminar and see us on a complimentary 1-hour meeting, and we'll sit down with you and go over those 50 questions on a complimentary basis. And you can take that and take it to your CPA for actions that you should take. You'll leave with specific action steps. And so in your folder, you'll find this right here. Then we can open it up for questions here in a second. It's just the last page in your, so a couple things. If you are interested in coming in to see us in Walnut Creek, above Scott's Seafood Restaurant, Morgan Stanley, you just complete that with your name, phone number, and email. We'll give you a call. We'll set up time for you to come in. We'll have our checklist. We'll go over and ask you questions. We'll complete it with you, and then you'll bring it to your CPA, and that'll help you for tax planning. So welcome to do that if you're interested. We'll take care of you on it. So with that, and that's what kind of the checklist looks like that we developed. Question, and then answer, and then potential actions for your CPA, and then whether or not you completed it. So people find it to be helpful. So with that, let's open up for some questions.